Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today, we're diving into the depths of Rogers Communications' latest annual report. And let me tell you, this one's got more twists than your phone contract. Rogers Communications, one of Canada's biggest telecom and media companies, just dropped their annual report on December 2024, and we're here to break down what it all means. Did they have a stellar year or did they drop the call? Let's find out. First, let's talk about how Rogers keeps track of everything. They have something called disclosure controls and procedures to make sure the information they share with investors is accurate. Basically, this is about how they ensure all the numbers and details in their reports are correct. The company believes its disclosure controls and procedures were working well as of December of 2024. They also have internal controls over financial reporting. Think of this as the company's system to prevent errors and fraud in their financial statements. Rogers management says these controls were effective at the end of 2024. Plus, their external auditors checked these internal controls and gave them a thumbs up. Time to talk about the people watching over the books. Every company needs an audit committee, a group of independent directors who make sure the financial reporting is on the level. Rogers has an audit committee financial expert, Robert Gemmell, which basically means someone on the committee knows their stuff when it comes to finance. He's independent, meaning he's not too cozy with the company's management, so he can give unbiased advice. Let's talk about KPMG, the accounting firm that Rogers hired to audit their annual financial statements. In 2024, Rogers paid KPMG about $14.9 million in fees. The year before that, it was about $13.9 million. Most of that money, about 93%, went towards audit fees, which is for checking the financial statements. The rest was for things like tax advice and other related services. Rogers has a system where the Audit and Risk Committee has to pre-approve any work they hire KPMG to do, so they are keeping an eye on things. Next up, off-balance sheet arrangements. These are basically deals or partnerships that aren't directly on Rogers' balance sheet but still affect their financial situation. Rogers says they don't have any major off-balance sheet arrangements, except for some they mentioned in their discussion, so nothing too crazy there. Rogers has committed to certain financial obligations in the future. These include things like payments for debt, leases, and purchase obligations. These obligations have an impact on the company's financial position. The Audit and Risk Committee is made up of Robert Gemmell, as mentioned before, as well as some other folks. It includes people such as English, Feckin, and Kazarian. Rogers wants to make sure the people making the decisions are well aware of the risks. Before we dive into financials, a quick note about shares. As of December 2024, Rogers had about 111 million Class A voting shares and about 424 million Class B non-voting shares outstanding. This matters because it affects things like earnings per share and voting power. Now let's check out the numbers. You know, the part that really matters. Looking at the consolidated statement of income, you can see Rogers' revenue for the year was close to $15.8 billion. That is up from about $15.4 billion the year before. That means Rogers made more money in 2024 than in 2023. The expenses are also up. The net income or profit came out to around $1.7 billion. Looking at the balance sheet, the company's assets totaled about $65.5 billion. That includes everything they own. The liabilities, or what they owe, totaled about $42.7 billion. This leaves about $22.8 billion in equity. It gives you a picture of what the company owns and owes and how healthy it is financially. The company's cash flow statement shows how cash moved in and out of the company. Rogers generated about $5.5 billion in cash from its operations, which is higher than the $5.2 billion the year before. The company spent some money on investments and acquisitions. They also used a bunch of cash to repay debts and pay dividends. Rogers uses financial instruments to manage risk. A financial instrument is a contract that creates a financial asset of one entity and a financial liability of another. The company talks about interest rate risk, credit risk, and other risks. They use various methods to manage these risks, including derivatives like forward contracts and swaps. The company goes over the estimates and judgments they used when preparing their financial statements. These include things like how they estimate the lifespan of their equipment, how they determine the value of goodwill, and how they calculate their taxes. These estimates can have a big impact on the numbers in the financial statements. Rogers also talks about the risks and uncertainties they face. These include things like competition from other telecom companies, changes in regulations, and technological advancements. They also face risks related to cybersecurity and data privacy. These risks could have a big impact on the company's future results. So, what's the verdict on Rogers? It seems like Rogers is in a pretty solid position. Their revenue is growing and they're generating a lot of cash. They've got a handle on their financial reporting and internal controls. They are managing risks. However, there are always things to keep an eye on. Competition in the telecom industry is fierce. Rogers needs to keep investing in new technologies to stay ahead of the game. They also need to be careful about managing their debt levels. Overall, Rogers appears to be in a good position, a stable company in Canada with few surprises on the horizon. Thanks for watching. If you found this helpful, please like, subscribe, and let me know in the comments what company you'd like me to decode next.